a lot of people who earn £50,000 a year, maybe they have a family, they won't feel like they are rich people. They won't feel like they're fair game for a chancellor looking to hit higher earners. But that is the reality.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Fidelity Investment Director Tom Stevenson to react to the budget, the government's annual set-piece update on tax, spending, and the state of the nation's finances, which was announced this week. There was a fair bit in there affecting your personal finances, and we'll get into all of it today. Before that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Tom, welcome along.
Hi, Ed.
We're talking the day after the budget. Let's start with a kind of overview, Tom. There was a feverish sort of mood surrounding this budget ahead of its delivery. Was it, in the end, as consequential as that hype suggested it would be?
Well, yeah, I mean, there was a huge amount of speculation ahead of there always is these days, increasingly. I mean, the days when what was in the budget was a secret until the Chancellor got to their feet are long gone now, and it's pretty unhelpful often. So there was a huge amount of speculation about the different measures, mainly the tax raising measures that we were likely to see. Quite a lot of them didn't actually show up, but I do think it was a fairly consequential budget. I think to understand it, you have to really think about the four audiences that the Chancellor had, and there's definitely a pecking order to those audiences. I think the first one was Labour backbenchers. That's important because the Chancellor and the Prime Minister actually are in an unpopular position, and they really needed to look after their own sort of positions, if you like. Second was the markets. And I think that, they did a pretty good job yesterday of pleasing the markets. I think the third audience is the business community. They were pretty horrid to businesses last year. They weren't so much this year. And then right at the bottom of the pecking order, I think, is the rest of us. Yep. And the reason why we're at the bottom of the pecking order, of course, is because the next election is 3 or 4 years away. And I think if you want to understand the shape of what was in the budget, the spending rises, the tax hikes to pay for those, the increase in what we call the headroom, the sort of buffer, all of those are really explained by that pecking order.
Yeah, and an overall tax raising budget of 26 billion. Yeah, we've seen bigger than that, haven't we? In sort of both directions, giveaways bigger than that, and tax raising budgets that are bigger than that. Yeah,
I mean, all in all, it was a pretty steady, unspectacular budget, really. I mean, the broad numbers are that spending, welfare spending was raised by about 10 billion. The headroom was raised by about 10 billion from the 10 billion that the Chancellor left last year to about just over 20 billion this time. And in order to pay for that, she had to find, as you say, 26 billion of extra taxes. So, none of those figures are particularly enormous. And I think the market reaction to that reflects that, because I think that, the markets were broadly relieved that was the shape of it. I think what is beginning to concern the markets, and we're beginning to see that today rather than yesterday, which is often the case, is a lot of the spending is up front now.
The good stuff.
The good stuff is now. And a lot of what's going to pay for it,
the pain
has been delayed. The tax rise, a lot of the tax rises don't kick in until 2028 or even 2029. In some cases, we'll come on to some of those individual measures, I'm sure. But what markets tend to look at is not just do the numbers add up, but when is a government going to pay for it? And that's really important.
And underlying when is, will it actually happen? Because a lot can happen between now and 2029 or 30. Right?
Absolutely right. And quite rightly, investors are suspicious of promises to spend money or to raise money close to an election, because when the election is less than a year away, that rather concentrates the mind.
Yes. Okay. So what did the government say, or actually the OBR, the Office for Budget Responsibility, what did they say about the strength of the UK economy then, Tom? And you mentioned the markets. How did they take it all?
So it was a bit of a mixed picture from the Office for Budget Responsibility. I mean, broadly speaking, they suggested that growth is going to be a little less than they were suggesting back in March. In the short term, actually, this year, a bit higher. But for the rest of the 5-year period, a bit slower, about 1.5% growth. And then how that translates into the sort of public finances was... Actually, what they're suggesting is that the public finances are not getting much worse, but they're also not really getting much better. If you look at the debts as a proportion of the size of the economy, then they've risen very sharply in recent years, and they're now expected to basically flatline for the foreseeable future. So that's not a particularly great position, but it's not getting worse, and I think that's what the the markets focused on, and that's why we saw gilt yields fall a bit yesterday.
Yeah,
that's a reflection of confidence from investors. Bond prices rising as bond yields fall. The stock market was pretty stable, actually went up a bit yesterday, and the pound was pretty stable as well. So I think the government will be relieved at the market reaction yesterday.
Yeah, I was going to say, like, job number one is it don't cause some absolute wobble in the market.
Yeah.
Right? And for any budget and any chancellor, that's the first tick in the box, whatever else follows.
Yeah.
Let's turn then, Tom, to some of the measures that were announced. Probably the most significant tax measure was not a rise in tax rates. It was an extended squeeze on thresholds. Some good old fiscal drag, Tom.
Yeah.
The personal allowance, the higher rate band and the additional rate band all frozen for an additional 3 years. These are bands that have been frozen for some time already. And it's forecast, Tom, to increase the number of taxpayers overall by 5.2 million people. And the number of high rate taxpayers, I couldn't barely believe this, that will increase by 4.8 million people by 2031. We thought, and we've said on the pod, we thought it would be very tempting for the Chancellor to freeze for longer, and so it proved.
Well, it's very tempting because it is a simple way of raising really a lot of money.
Not the simplest way. There's a more simple way.
Well, that's exactly right. There is a simpler way, which is to raise the percentage level of the income tax rate.
Yeah.
You could, and they chose not to do that. There was a lot of speculation in the run up to the budget that they might do that. They shied away from doing that because it would have involved breaking a manifesto promise. They didn't, feel that they were in a strong enough position to do that. So they shied away from that, and they went back to this old ruse of fiscal drag, of leaving the thresholds at which you move into a higher tax band in place, so that as people's salaries increase over time to keep up with inflation, more and more people, as you say, move into the higher rate tax bands. This has been going on since 2021. I think it was Rishi Sunak who introduced the first freeze. The freeze was due to run out in 2028. What the Chancellor said yesterday was that there will be 3 more years of it. Now, it was expected that there'd be 2 more years of this.
Yeah.
Adding the extra year makes a big difference, actually, because by the 2030-31 year, this will effectively mean that the government is receiving more than £12 billion a year more than they would have done otherwise. So it's a big revenue earner. But it is, it's sometimes described as a stealth tax. That's exactly what it is, because it has exactly the same effect as raising the income tax rate. But a lot of people don't really understand it.
And you don't feel it in your pay packet in quite the same way. You don't see, I've got less money this month. What you see is, well, I've been paid more, I'm just keeping slightly less of it than I would otherwise, and it's all a bit lost in the detail.
And the fact that it will have gone on for 10 years is, I mean, that's a lot of pay rises.
Yeah, and I mentioned this figure: 4.8 million people will be pushed to become higher rate taxpayers. I think the numbers move about a bit, but I think that means that a quarter of taxpayers are going to be in that higher rate band.
Yeah,
and it really will keep going or resurrect these discussions and these arguments about, what is a high earner? What should be the target of a tax like that? Because
what is an ordinary working person? Because I mean, the Chancellor uses that expression a lot. She talks a lot about ordinary working people, but we're talking about. The higher rate tax band kicks in at a £50,000 a year salary. A lot of people who earn £50,000 a year, maybe they have a family.
Yeah,
they won't feel like they are rich people. They won't feel like they're fair game for a chancellor looking to hit higher earners. But that is the reality.
That is indeed the reality. Another significant tax rise came via changes to the rules on salary sacrifice. Bit of a technical area, but we're going to walk people through it, Tom. What was that change and how much is it expected to raise?
Yeah, so salary sacrifice is a mechanism whereby people who are saving into their pension through a workplace scheme can do it in a very tax efficient way because salary sacrifice allows you to avoid paying national insurance. First of all, you don't pay income tax on your contributions to your pension, but in addition, you don't pay national insurance. So for anyone earning less than that £50,000 threshold, that means you're saving 8% national insurance. Anyone earning more than that, you're saving 2%. Perhaps more importantly, your employer also saves their national insurance contribution, which is 15%. So it potentially is very costly for the government. So I can see why it was in their sights. The reality actually is that it doesn't save a huge amount of money. So if you look in the back of the budget document, there's a very helpful table which says how much money is going to be saved or how much it's going to cost for each individual measure. And if you look at the one for salary sacrifice, in the 29-30 tax year, it's expected to raise about £5 billion for the government. But if you look at the next year, the 2030-31 year, it's down to about £2.5 billion. And I presume that the reason why it falls away is because the OBR that comes up with these figures is expecting businesses to change their behaviour, to change, whether they're offering pension schemes or how they offer them. Yeah. And so actually this is going to, the benefit falls away quite quickly.
Yeah, we'll get to the uncertainty around how it changes behaviour. But just on the numbers, and it's not on the face of it that costly to individuals, as you say. Basically, you can sacrifice salary up to a limit of £2,000 with no NI, but everything over that, you'll have to pay your normal NI on it. Now, for earnings over about £50,000, NI is 2%. So I've got an example here. Were you to sacrifice £10,000 into a pension, by the way, we should say that all this affects salary sacrifice into a pension. Other sort of salary sacrifice measures for company cars and cycle to work
are unaffected.
They're unaffected.
Yep.
But in that circumstance, it's £10,000 into a pension through salary sacrifice. 8,000 of that falls over the £2,000 cap, and that's going to generate a 2% NI bill. It's 160 quid. Not nothing, but the much bigger bill will land on the employer, and that raises the question about what they then decide to do. And many people fear that this will just really, so as to avoid just a big extra tax bill for the employer, they'll just say, well, you're getting less into your pension. A lot of companies offer more than the minimums on your pension contributions, and that will put that under pressure, won't it?
I think it's very likely that it will, and I think that explains that fall off in the expected revenue from the tax. And so you have to ask yourself, is that a good thing? There is general understanding that people are not saving enough into their pensions.
Yeah.
There is the government set in place a pensions commission back in July of this year to investigate why that might be and what can be done about it. So it does seem slightly counterintuitive to set off that pension commission and then a few months later to introduce a measure which actually makes it at the margins slightly less favourable to save into a pension. It seems slightly contradictory.
Yeah, and there's a few more, I think, very important things to say about this. First, in terms of what was announced, you still will be able to sacrifice salary above 2,000 is the point. So if you want to bring your salary lower, because maybe a tax threshold, but actually you don't have to sacrifice salary to beat those tax thresholds. A pension contribution will do that anyway. But for certain thresholds in the benefit system, so £100,000 is again a big number here because that's the point at which households lose free childcare. 80,000 is another threshold where child benefit ends. So you might want to manage your salary down to those thresholds to keep those valuable benefits. You can still do it. There's just a bit of
extra cost.
Yeah. And it's important to say that, you can still make pension contributions to beat those tax thresholds. That's not a sort of escape hatch that's now been shut.
Yes, I think it's really important to make that point that pensions still remain a very tax efficient way to save for your retirement and a very effective way to beat these tax anomalies, these sort of cliff edge points at which your tax rate rises. So I think people shouldn't come away from this thinking, oh, salary sacrifice has been more or less scrapped. And therefore, I should rethink my whole approach to pensions. I think it is still very much the right thing for people to do. It's just at the margin going to cost a little bit more.
Yeah, and just finally, before we move on, it could lead to all sorts of changes of behaviour or changes in the relationship between employers and employees. I saw people speculating that, well, what if you come up with some sort of more formal arrangement with your employee? You just simply would, you just agree to get paid less on a kind of ongoing basis, but you're going to swap that for pension contributions. It will depend on people's circumstances, how this works. And it's not coming in. Straight away. It's not coming in for some years, in fact.
Well, I mean, and this we should have mentioned this. I mean, this measure is not going to be implemented until 2029. Which is much later than people expected. I think when we saw that yesterday, we were a bit surprised because I think the whole industry had sort of, was gearing up and resigned itself to the fact that this was likely to be implemented in 2027. So I think it's a bit unclear as to why it's been delayed. I mean, obviously there are sort of administrative wrinkles that need to be ironed out to work out exactly how to do this. But that's a very long time.
It is a long time. I mean, that's what I would guess at. I mean, it's always the way you're asking. It's all very well for the government to say this is the law now, but an industry and their sort of their systems have to be able to cope, don't they? And it might not be as it might take time. Okay. There were some genuine tax rises going on in this budget, Tom, on certain types of income. Who's going to be paying more or higher rates of tax, Tom, as a result of the budget?
Yeah, and I think that there were three important ones, and they were unexpected. Actually, I mean, it's not often.
Yeah, they were.
These days, it's not often that you get something in the budget that's genuinely unexpected. But extra tax for savers. For investors in shares outside a tax shelter like an ISA or a pension, and landlords. So all of those were learned yesterday that the tax that they pay is going to rise by 2 pence in the pound. pretty much across the board. I think there's one of those cases where it's actually I think it's dividends, actually the top rate, the very top rate, it remains unchanged. Okay. But the others are all shifting up by 2 pence in the pound.
And to take one of those examples, so they've created a category now of property income, property income tax, and the higher rate band for that is 42%, as opposed to 40% for regular earnings.
Yeah.
Now, cynics will say, Tom, that by sort of creating a new category for these things, suddenly they can become targets in and of themselves.
Yeah.
I'm particularly thinking around property income here. Tax from buy-to-let is very, very punitive these days. And it's going to be very tempting, isn't it, for future governments to say, let's raise that 42% a little bit, because it's not going to affect all the other taxpayers.
Yes, and that's the interesting one, actually, because I mean the dividend tax is an existing tax which has just been increased. The savings tax, I don't think that's a new tax, is it? But anyway, the property tax, the landlord's tax, effectively is a new tax, and I think you're right. You know, very often taxes which over time become quite onerous, they start out being quite insignificant, and people don't really worry too much about those. And yes, by ring fencing it, by making it a separate tax, it is easier in future to just simply bump up the rate or to lower the thresholds or whatever. I don't think you have to be particularly cynical to think that that's the case.
And more complexity. I mean, all of this is more complexity, isn't it? But hell's bells, more complexity in the tax system. I mean, it really is a minefield. Especially if you've got income from multiple different sources, it's really, really complicated. Okay, well, there is a lot to get. You know, Tom, it's a busy budget when you and I come and talk, and we're not talking about the things that didn't happen. Yes. That's when nothing's happened in a budget. When we're like, well, this didn't happen and that didn't happen. There's lots to talk about that did happen.
Well, we had a new expression, didn't we? The smorgasbord of tax, and that's exactly what it was. I mean, they abandoned the idea of just having a simple tax rise, and the only way to replace a big across-the-board tax rise is to have lots of little ones, and that's what we got.
Yeah, okay. One more consequential change that many of our audience are going to be affected by is changes to ISAs, Tom. This one was expected and it duly arrived. So what is happening?
Yes. So, and there was a lot of speculation about this one, and it was basically delivered as speculated, which is that the government has decided to treat cash ISAs differently from stocks and shares ISAs. So from, I think,
April 27?
27, yeah. From 27, you will only be allowed to pay £12,000 into a cash ISA, as opposed to £20,000 into a stocks and shares ISA. Or rather, within that 20,000, only 12,000 can go into cash, unless you happen to be over 65. And this was an unexpected element of the announcement, which is that older savers will still be allowed to pay the full £20,000 into the cash, into a cash ISA. I think, there are two reasons for that. One is, obviously a sort of a political reason to avoid a backlash from certain quarters of the media about limiting people, or forcing people who wanted to save in cash, forcing them into the stock market at the wrong time. So that's one reason they did it. But I think there's a policy logic to it. I mean, if the main reason for doing this is to encourage people to get better savings and investment outcomes by getting an exposure to the stock market, which, as we know, over time has delivered better returns than cash and inflation-beating returns, it makes sense to target that measure at younger people who have longer to benefit from the better returns from the stock market, and also have less reason to de-risk their financial situations. Yeah. So I actually think that it's been broadly welcomed, and I think it is actually quite a sensible tweak to what we were otherwise expecting.
Yeah, I think so. I think it's just the age thing, isn't it? When people get above a certain age, is it sensible for them to be exposed to the stock market, given their timelines? I wasn't that surprised about that caveat. A couple of extra things we should say. This is for money put into ISAs from 27 onwards. So everything you've got in the past, it doesn't suddenly have to all move into shares or what have you.
Yeah.
There are some technical questions that I guess will have to be ironed out. I don't know if we have answers on these yet. We've spoken before, Tom, how it is possible to have a stocks and shares ISA, but to hold within that assets that actually perform exactly like cash and give you a return very, very similar to a cash account through money market funds, short-term bond funds, cash funds inside a stocks and shares ISA. It might not be as pure as holding it in a cash ISA account because there might be a platform fee to pay. There might technically be some risk, but volatility is very, very low. It's going to be a question, isn't it, whether that is sort of ruled in the scope of this limit.
Yes, and I think that's one of the reasons why this is not being implemented until 2027 is because those things need to be ironed out. I mean, currently, as it stands, if you want to have the safety of a cash investment within a stocks and shares ISA, you can achieve that, as you say, by putting your money in what's called a cash fund. It's technically not a cash fund. Yeah. It's short-term fixed income instruments, but basically it behaves just like a cash fund.
And indeed, a lot of investing platforms, including Fidelity, will pay you interest on money, even if it's not put in any funds, just by being sat on the platform. Obviously, take off the platform charge from that, but we'll see what the government has to say about all of that, right?
And it also remains to be seen whether this actually achieves what the government intends, which is to encourage people who are otherwise sitting in cash into stocks and shares. I mean, there is an argument that, people are sitting in cash for a reason. It's because they want to be in cash. Are they really going to move across into stocks and shares? That remains to be seen.
Yes, indeed. Okay. The last measure, Tom, I've left to last. I think it's probably the one that will cause the most noise going forward. This is my prediction, at least. And this is the tax on high-end property. So what is happening?
Yes. So not surprised that the government has targeted the property market. An awful lot of wealth is tied up in the property market. It's also politically relatively risk-free for the government to target people with properties valued at more than £2 million, which is what they've done. So what they've essentially said is that there will be a surcharge in addition to the regular council tax, which everyone pays, for people owning properties worth more than £2 million. It's a sliding scale. So at £2 million, you will pay an extra £2,500 a year in this surcharge, council tax surcharge, rising to £7,500 for people lucky enough to live in a £5 million property. In order for that to happen, properties will need to be revalued because, as we know, the council tax system is based on valuations that were made in 1991. So they're very out of date. So in order for that to work, you're going to need to revalue at least some of the properties. And they may well choose to do that by valuing properties in the highest council tax bands. At the moment, we don't know how they're going to do it, but they will need to do something. So that's one uncertainty. The other uncertainty is that, there are a number of people who because of their circumstances, live in extremely valuable properties, but they don't have a huge amount of cash. So they may not be able to simply just fork out $2,500 or $5,000 or whatever it is a year. So we think that there will be a consultation on a mechanism for allowing people to roll up what they owe and then to pay that to the government when they sell the property or their estate when they die. We don't know how that's going to work.
No, and that's been the speculation. There is so much to say about this. The government's going to consult on how it's going to work in practice, and it said we're going to look and identify people who might need support in paying this. And I guess that's what they are hinting at there, some kind of mechanism. But look, they've put a figure on how much they think this will raise in the future. That's 400 million by 29-30. I would say that is a total finger in the air number.
Yeah.
I'm sure there's some method behind it, but especially if we're going to have a mechanism that allows people to roll up their tax. So are they going to pay it?
Well, that's an interesting feature because if you do that, then you get unintended consequences because effectively, you're potentially clogging up the housing market because people are going to put off moving when they might have considered moving. Yeah. And this is what happens when you start, fiddling around with taxes. You tend to get unintended consequences.
Yeah. Sorry, and I think that there will be people quite worried about this because there'll be lots of people these are the lucky ones. They're in big, expensive houses, or certainly expensive houses. But in the southeast of London, doesn't even have to be a big house to be worth certainly more than £1 million. And a lot of people will say, well, I bought this house. I intend to stay here for some time. I'm probably going to get, pushed into this bracket at some point. Do I have £2,500, which is what, 200 and something pounds a month, free in order to pay extra tax? And a lot of them will say, well, no, or at least not comfortably. And then if they are allowed to roll it up, I mean, think of that for a moment, how long people actually own houses for. Yeah. If 20 years of rolled up council tax surcharge is going to be tens of thousands of pounds. And as you say, that's a pretty big disincentive to sell that property.
Yeah, well, I mean, it's a disincentive to own property at all because there's a big charge on the way in terms of stamp duty, and now there's potentially going to be a big charge on the way out. So I mean, I think you're right that this is going to be one which once people start working through the implications of it and understanding really what it means, I think there'll be a lot of noise about this.
Yeah, and look, this is a wealth tax, and there's been sort of talk about some kind of more genuine wealth tax that goes beyond CGT or whatever. And one of the traditional objections to that tax has been, well, so much of our wealth is held in property. You cannot break off a bit of a house and give it to the taxman. These are illiquid assets, and the mechanisms that we're talking about are designed to kind of break through that and overcome it. It's interesting to me that if they do this and they push through in the face of these objections and overcome these obstacles, and that opens the door to all sorts of other types of taxes, I would say. And I'm not making political judgments about whether that we should have them or not. I just think that one of the big objections to wealth taxes might be done away with.
Yeah, well, it creates the mechanism for doing it. And to your earlier point, about once you've set something in place, it becomes easier to, in this case, to either increase the surcharge or lower the threshold for it. So, it's currently set at 2 million. But what if you say, well, actually 1.75 million? And also just over time, the same fiscal drag. I mean, the one thing you can be sure of, that £2 million is not going to rise. That £2 million is going to be, the maximum that it is forevermore. Yeah. And more houses will move into that. So,
yeah, it's going to be, well, this one, I don't know if we have a time for this one to be introduced.
We do. I'm afraid I can't remember it. It's 27 or 28.
But like all these changes, there'll be a lot of consultation and a lot of kind of thrashing out and lobbying around it. So we'll see exactly what comes to pass, Tom. Look, we've covered absolutely loads there, Tom. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or share the episodes. It really does help people find what we're doing here. That all said, Tom, thanks for joining me.
Thanks, Ed.